Company money versus my money. 5 hard lessons on how I actually get paid. Welcome back to season 17 of Zulf Talks podcast. I'm sharing all of this with you from my personal experience of running my company. One of the biggest shocks of moving from an employee to a business owner is realizing that even if your business makes money, you might not have any in your pocket yet. As I build this podcast episode for trustedcreators.org, I have to be incredibly disciplined about how I move my money about. Today I'm breaking down the confusing world of paying yourself so you don't end up in a hot water with the tax man and you've got enough money to pay yourself. This is the life of being self-employed or a director for your company.
Working for yourself, I know you love it. Working for yourself, cause I love it too. Working for yourself, Zulf talks about it, making it easy for you. Working for yourself, go be your own boss. Working for yourself, Zulf will help you along. Working for yourself, powered by trusted creators, zulftalks.com.
Understanding the flow of money is the difference between a hobby and a sustainable business. This journey is powered by trustedcreators.org. If you want to see the simple layout and template notes for this, keep your mind on zulftalks.com. You've got a list of resources from this episode. So I wanted to make sure that I cover as much as I can in this series 17. We're on episode 5. And we're going through this step by step. We've gone through, if you remember early on, why you should work for yourself, should you leave your job early, the differences between a limited company and setting up your self-employment. But you want to make sure that if you're setting up and you've got enough money coming into your business, you do it in the right way, because there's going to be some key elements versus company money and my money. What's the hard lessons I learned? Well, it's very difficult. I'm going to cover them in 5 points hopefully today. 5 hard lessons. Let me give you an overview of those. So there's a great divorce. There's the salary, there's a dividend, there's a director's loan, separate person mindset, the accountant myth. 5 things I'm going to talk about today. So the great divorce, what's that all about? Why company money / your money, and the danger of treating your business account like a personal ATM. You need to consider, if you've gone down my route and you're looking at what I've done, I moved from self-employed to company director, set up a company. When you're self-employed, you think about money in a totally different way. It's a hard thing to get your mind around, but once you get it nailed into your head, you'll be a lot wiser. And you'll have a lot more easy conversations with the accountant, because the accountants speak in this weird foreign language and it's hard to understand them. But this one key element will help you. If you've got personal money in your personal account, that's yours. If you've got a company bank account, your company's made some money, it's gone into your company account. Is that money yours? No. Not until it's either paid to you or you've borrowed it, where it becomes a bit tricky. So let me explain that. Your company's made some money. You've sent out an invoice. The invoice has been paid. You've got 50 grand sitting in your company account. Now, this year you've earned £50,000 in the company account. The accountant does your accounts return for the company. The company pays the tax on that money. It's sitting in your account. If you've got payroll set up and you're getting paid a salary from that company, you've got money coming into you. When it comes to you, that's your money. If it's done really well, you can take a chunk of that money as a dividend payment and you pay the tax on it. Sounds like you're paying a lot of tax in lots of different places, but it's a key sign that you're doing well if you've got the money there and payroll and you can take dividends. That's the great divorce. You have to make sure you know what the difference is between the company money and your money, when it's the company's, when it's yours, and that journey of it moving from the company to you and you tracking how much you've taken and when you've taken it and which tax year. Because if you take too much in one tax year, you end up paying a lot of tax. So you want to be smart about maybe not taking it all in one go. Which brings us to the second point, the salary versus dividend split. Plain English breakdown of this is the most tax efficient way to actually get cash into your personal bank account. Think about it like this. Your bank account is your bank account. The company has its account. You've done well. You've got 100k sitting in your company account. You decide this tax year, I want to take £40,000 of that, please. You let your accountant know that I'm taking £40,000 as a dividend payment. They'll say to you, actually, you know what, if you take £40,000, we're paying you a salary out of this account as well. So are you sure you're going to take this amount? Because you'll have to pay you, I don't know, 9.5% or 9.75 or 20% or whatever the percentage may be. And then at that point, you'll be like, oh, okay, what can I do to not pay as much tax? Is there a better way of doing this? They'll be like, well, yeah, what do you need the money for? And you'll say your reason. Okay. Is that a business expense? Potentially. So you can change that. Dividend payments are very interesting and you want to consider them because you've got your main account, you've got your dividend payment account. And I think of it like this. If I get my salary, If I get a dividend, that's like a little bonus. The director's loan account is like a big thing as well to think about. I don't like to borrow money from the company unless I'm taking it as a salary or a dividend. A salary is, this is what I get each year. A dividend is, I got a bonus because we did well. The loan account is like you're borrowing money from the company which you need to pay back at some point. I don't like to do that. I totally don't like that at all. It's an option there, but you would need to do your own research and find out if that's something that you want to consider or if that's something that will help you in your journey. There's a separate person mindset here. What clicked for me was the mental click that helped me view my company as a separate entity that employs me. So think of it like this. You've got your company. It's your company, okay, but you're an employee for the company. So I always think of like, okay, that's the company. I'm working for it. I get paid a salary. And if it does well, I get paid a bonus, which is the dividend. That's how I think about it. And then that way it clears it up for you that you're not confused, because you can easily get into the mindset that the company's done thousands and thousands of pounds of profit and it's my money. Until I'm paid, it's not my money. And all I need to do is manage it in a way that while it's there, it's doing good. Find out what's the best amount I can take when I need it. Is it better that it stays with the company, or is it better that I take it and then put it somewhere else for savings, like cash ISAs or stocks and shares ISAs, or, you know, whatever you may do. There's a whole another section about savings and what you can do with the money. Is it better that the company reinvests that money to make the company better, bigger? Should I set up another company which then looks after the money that the profit is sitting there? Like you can have multiple companies. So there's loads of options there, but it starts getting complicated. But I want to give you this as a main overview, that having the company there does open up options to do other things. Do you want to buy another building and have that rented out and have a company that looks after that as a rental income? And there's loads of stuff you can do. So consider that as a good benefit of having the mindset of it's a separate entity, but you're looking after it and they pay you. There's a common accountant myth that I want to cover as well. Why you must understand your own payout structure, even if you have a professional handling your books. I'll give you a great example here. You already know, if you listen to my episodes, the accountant wasn't very good. And they were like giving you the large on their social media and giving you every trick. Oh yeah, you've got a director's benefit. You can use director's loan account. You've got director's benefits where you can take small amounts of money out each year and buy stuff up to £300 a year and all these fancy little things. And they give you all this, they're the bee's knees. You go and you become a client with them and you don't see that person on the camera. You see some team member. Now, this is how it works. The accountants do what they need to do. And from my experience, they've been very lazy. They'll just do what they need to do. You're not going to get any amazing stuff from them. The main benefits come from financial advisors. And there's a big difference. You need to understand that accountant is basically like a paper pushing number person that fills out boxes, and they're very limited in what they can do. Your financial advisor is the one that you think is your accountant. Before you knew it, you thought your accountant would give you this information, but they don't. You need to get a separate financial advisor who lets you know what you can do with your money, how you can move that around, how it can work better for you, how much you should take, what you should do with the profits, like the stuff that you thought accountants do, which they don't do. So I always had a spreadsheet. Moved from a sole trader to a company, but I still kept that spreadsheet. I used the online management tools, but I knew if I'm taking money, I want to track how much money I've taken, when I've taken it, what I used it for. So anytime I've taken money out of my accounts, I took out like a certain amount. I could take out £40,000 comfortably. I took 60,000, I took 50,000, depending on the time it was. But I logged each of those and I made sure those were in my, this is where it gets confusing. Your company has a tax return for a specific year. Let's say it's from like January to December. I'm just making it easy so we can explain it. So if I take money between January and December, it falls within this tax year. What happens if I take money in December and then in January? If I take two, one falls in this tax year and one falls in the next tax year. So knowing those days means in your company's accounts, you've taken money out in 2025 tax year, but then in 2026, because it was January 2026, that new amount falls in the second tax year. So you could take £40,000 end of one year, £40,000 start of the next year. You've used 2 years of allocation, you've got 100K. But at the same time, remember you have a personal tax return. The person one runs from April to March, March to April, the slightly different days, the standard UK like tax days. So you have to be careful that if you've taken that money, it might all fall in your own personal tax year for 1 year. So the correct thing, if you're following along, it might be tricky here, but if you're not good at dates. So in that example, I've given you December and January, that would fall in one tax year because it's between April and April. If I took it in December and then took the next one in May of the following year, then that would be like 2 separate tax years for the company and 2 separate tax years for your personal one. So one thing you need to do is have your own calendar, have the dates marked out of what your tax return days are, like what year your company tax returns are. What I mean by that is if you spend money today, which tax year does that fall in? If you spend money in 3 months' time, what tax year does that fall in? Knowing that will be a big benefit for you if you've got a big expense coming up, because you can make use of multiple tax years, take a little bit more money out and spread the cost. And then the tax is like you don't hit the limits because each tax year is different. I'm getting a bit complicated there, but there's an accountant myth that they use, that they do everything, but they don't really do everything. You got to be on top of your figures, because ultimately, even having an accountant, when they send you your accounts for the year, they have a sneaky page there that says, you make sure to check everything on this page or you're signing it off, even though we've prepared it. Ask us any questions if you think something's wrong. You need to let us know. So like they're putting the onus on you. And if there's ever a tax investigation or something goes wrong, the Inland Revenue is going to come to you, and then you have to kind of answer all the questions. So don't leave it all on your accountant. You need to know the numbers as well as your accountant does, if not better. Understand why you're doing stuff a certain way, why expenses are going in a certain way. Can you prove the numbers they're using are right? And if you're not sure, ask them, how did you come up with this number? I don't see this number. So like match up with them. So there's loads of things there, to help you out. But I feel like this is a common thing that people don't think about when it comes to company money, my money. And these are 5 hard lessons, because if you understand these points, you won't make mistakes, because a mistake like this can cost you quite a lot. Imagine it. I wanted to buy a house. I wanted to take out £100,000. I took them out in the wrong tax year. I ended up paying 20% extra tax. Whereas if I was smart enough to work out these little changes, I could have positioned it better and taken it out in a different way, which I wouldn't have paid 20% tax, costing me £20,000. So there's things there that are hard lessons, but you need to understand it from your point of view, the accountant's point of view, and whose money is it and where is it sitting. That's the amazing world of business. Once you get your head around it, it becomes daily life. But when you're thinking about it, if you're not done it yet, don't let it confuse you. It's a journey. As long as you're thinking about it and you're asking the questions, you'll be in a position where you'll be better. Hopefully, this one is helping you along. What we got in the next one? The hidden costs of running a business. We spoke a little bit about it earlier, but I want to go into like the prevent the nasty surprises, and I'm going to give you some figures as well. So the next episode, we'll have some facts about what that is and 5 key things to consider. I'll see you in the next episode. It would be really good if you can leave a review wherever you're listening to this. The show resources are available at zulftalks.com.